Good morning, good afternoon, good evening, wherever you are in the world. My name is Mark McAllister. I'm Senior Partner for Holborn, based here in Cape Town. And welcome to our webinar discussing the latest tax changes that are likely to impact on your foreign pension. Foreign pensions under fire. I'm joined today by a number of panelists. If you want to join in with the discussion, feel free, if you're on Zoom, to ask a question in the Q&A button at the bottom of the screen, or you can send us a WhatsApp by scanning this QR code, and the team will do our best to respond to the questions as we go. A little bit about us, for those that haven't met us. We are Holborn Assets. We're a global company, been around for over 25 years now. We've got nearly $3 billion under management and administration, with clients in over 30 countries and offices in 11 countries, including South Africa, where we have 4 offices. Feel free to check us out on Trustpilot. We've got over 2,350 happy client reviews, and we are experts in cross-border financial planning and tax structuring. Today I'm joined by 2 panelist speakers with extensive experience in the subject matter that we're talking about. Unfortunately, Janine isn't with us right now. She has unfortunately had a family emergency, very short notice. We're hoping that another member of her team will be joining in her place, but we still have the material from her that we will be covering in her absence. And I'm hoping that either Janine or one of her team are able to join when we get to the Q&A session. So for now, you've just got myself and Jeff Dorr, who is a fiduciary specialist and a senior associate with our business. Jeff has over 12 years experience in global financial services, including asset management and wealth planning, and in particular is a specialist around foreign pensions. So Jeff, it's just you and me for now. How are you doing?
Just the boys club today. Good to see you, Mark. Thanks for the invite.
Good to have you on board. Okay, so let's get started then. Pensions under fire, and from 2 countries. The common misconception is that this is one-way traffic. And why is it 2 ways? Well, we are here to discuss predominantly the end of a potential income tax exemption in South Africa. But let's not forget, the UK budget last year also dropped a little bit of a hidden bombshell in that UK pensions might be included in inheritance tax calculations from 2027. Both changes are not 100% confirmed, but we are here to provide you what information we can at this early stage so that you can plan appropriately. Let's start off, though, with South Africa. This is the big one. And what is it all about? Well, there's this famous foreign pension exemption. You may or may not have heard about it. It does exist, well, currently anyway. Its formal name is Section 10(1) GC-2 of the Income Tax Act, and it's an exemption for foreign sourced pensions, annuities, lump sums, if you've worked and contributed into that pension scheme from foreign employment from your employer as well, outside of South Africa. So it excludes South African retirement funds, and it's been around for about 25 years now. So the idea originally was to attract retirees who are quite often very wealthy, and also reduce the burden on SARS so that it was easier for them to administrate. So let's talk through then what that looks like. Well, here's the formal binding general ruling, from last updated in 2017. So even though this exemption has been around for well over 2 decades, this is the last time pen was put to paper by the Revenue Service. And there you can see it exemplifies what 10(1) GC-2 actually means. This is the bit that's got everyone concerned. So just to be clear, this has not happened yet, but let me read to you what government are planning. So the current treatment of cross-border retirement funds may result in double non-taxation, particularly where South Africa is granted the taxing right by treaty. In particular, this happens if you have a UK pension and an NT code in place. We'll come on to that a bit more in a bit. It is proposed that changes be made to the rules that currently exempt lump sums, pensions, annuities received by South African residents from foreign retirement funds for previous employment outside South Africa, with amendments in the current legislative cycle. You can see it there in Chapter 4 on page 42 of the 2025 budget. What does that mean? The likely change or removal of Section 10(1) GC-2. So what are they trying to address? Well, all these points as per the wording of that paragraph. What's the key points really? Well, current legislative cycle. Jeff, I don't know, what's your view on this? It's not very clear for the layperson what is changing and when's it likely to change?
So it's interesting because this is the second target on global assets or global affairs. And just think back to 2020, we had the expat tax in the news. Every press release was about expat tax, and that was really targeted at South African residents, still South African tax residents, working abroad, earning income from a foreign employer. And that exemption was reduced substantially. People had to, make some very drastic changes, either officially tax immigrate or come back to South Africa because the cost of living abroad just became, on top of those taxes, simply became, not really feasible. And so this is the next in line. We're looking at where they've provided relief for individuals who have planned effectively for their retirement, but they haven't received the relief that a normal South African resident would receive when funding a local retirement fund. You all need to remember that a local retirement fund, when you make contributions to it, is tax deductible, albeit up to a percentage, but it's tax deductible. Now, someone who's abroad that's now funding a retirement plan and working abroad and looking towards their retirement doesn't receive that relief. So this, in effect, whilst it was to attract retirees, was also to level the playing field between someone who is abroad funding retirement, planning on returning, and someone who is still on the ground in South Africa receiving that tax relief up front. So doing away with it at this point, it's going to put people in a very difficult position. And I understand the concept of dealing with the double non-taxation. But we need to consider how cost of living has changed massively. We need to consider why this exemption is now coming into place where it's been in place, being removed when it's been in place for so long. So I definitely see it coming as a part of the budget review later in the year. And my one piece of advice is make sure that you are informed about how this will impact your income and your income from your foreign pension, and make sure that you have the conversation with a professional to put yourself back in a favorable tax position, because that is possible.
Yeah, and it's just to be clear, it's not clear really from this, is it? When we keep referring to it now as the new D-Day, we had a D-Day before with the change of the Section 10(1)(0), that famous expat tax, and we don't know when this D-Day will be yet, but we're hoping that some kind of clarity will come from government in the not too distant future. Okay, and also I'm very pleased to announce Lizette from Galbraith Rushdie has joined us. Lizette, thank you so much for stepping in at the last minute in place of Janine. So we'll bring you in a second if that's okay. So welcome to the webinar. Excuse me. Right, let's move on. So, what are the potential implications for the people on this webinar that you need to think about? Well, there's three main areas really that this could impact you. So the first one is in your world, the financial impact. So potentially higher taxes could mean reduced retirement income. So you need to look at your expenses if you are, subject to this change, and can you afford that extra tax burden that you haven't got currently? Likewise, it states that lump sums are potentially taxable too. So, if you delay in taking funds out beyond this change, could that cost you dearly? And again, this is what Jeff is saying, and rightly so, to look at those options before time, not afterwards. From a behavioural perspective, potentially current retirees might think emigration is an option. So do they defend their wealth by moving out of South Africa to a different jurisdiction? And is it potentially going to put off other retirees that are currently in the UK from moving back to South Africa? We'll see that in time, I'm sure. And lastly, the economic impact. Particularly here in the Western Cape, there's a lot of foreign retirees that come here to enjoy the weather, enjoy their retirement. Are we potentially going to see a reduction in those retirees, their spending, the investment, the employment that it creates? Is this potentially going to be the South African government shooting themselves in the foot, so to speak? Again, those impacts we'll only know over time. So this is where I'm going to bring Lizette in on behalf of Janine, and Janine was very kind to set over some examples of what this actually translates into from a numbers point of view. So we've got two examples here, and what I've done is sort of trying to put this graphically and visually. So the first one is, let's say you are taking £3,000 a month, £36,000 a year out of a UK pension pot. I've imagined hypothetically about £900,000. Drawing 4% a year in what's called a drawdown arrangement. It's quite common. So £36,000 a year would equate to 838,000 rands per annum, 70-odd thousand rands a month. And if you have gone through the process with Janine and her team, as we often recommend, and got your NT code in place, well, all of that money currently would end up in your personal bank account. So, there we go. You can see it on the right-hand side. If you don't have an NT code, then you will be probably taxed in the UK. That's the way the payroll systems work over there. But if you're in South Africa as a tax resident here and you've got your NT code in place, this could be what you look like on paper if you're drawing £3,000 a year. This is where I'm going to bring Lizette in now. So Lizette, let's imagine that same client, same situation. And here we go. Here's the numbers that you guys kindly put together. So £36,000 gross, as we would say now. And after this change, that will reduce to £25,000 net per annum. So, a cost to the client in tax that they aren't paying at the moment of about £11,000 a year, or 220,000 rand, £905 a month, nearly 18,000 odd rand a month is how much this is going to cost someone in that situation. What's your thoughts on that? Anything you can add, Lizette, to clients that are watching and concerned about this change?
Well, we've got quite a lot of clients that this will definitely impact. Especially clients that only come here for like 6 months of the year. So yes, obviously that will have a great impact on everybody. I mean, to all of a sudden have to pay 217,000 worth in tax is a quite a big sum to pay. So
Yeah.
yes, I mean, I'm sure we can, there's not a lot of deductions you can do there. Everything will pretty much just be straightforward pension taxable. So I'm just thinking there's no other deductions that we can also include. I mean, the best part would be for, yes,
Not ideal.
I would think, it's definitely not ideal. I mean, sure.
Well, it only
a lot of
gets
clients
worse.
actually come here for the reason that they don't have to pay tax on the UK pensions, especially UK pensions, but other pensions obviously as well. So
Yeah,
yes.
look, I mean, we've got numerous clients in that category, right? They come here for the quality of life. They come here for the reduced cost of living. The inflation rate isn't as high, relatively speaking, with what's been happening in Europe in the last few years. And look, if we take this next example that you guys have put together, £5,000 a month, so someone that's taking £60,000 a year, and again, same example, that they've got an NT code in place, they're a South African tax resident, they would have received 1.4 million rand tax-free.
Now they're only getting
and
right.
then
So now you're only getting 68% of what you would have gotten. It's a big drawdown. It's actually quite shocking. I really do hope that this doesn't go through, but I can actually see where SARS would maybe come from, considering the deficits that we've got on this side in terms of tax revenue. So
absolutely. Well, we said this when the Section 1010 change happened in 2020. If we're at this sort of level of what we would almost say looking down the back of the sofa for tax revenue, I think this one's quite a short-sighted one, let's put it that way, because the kind of people that want to retire here with these kind of assets, they provide employment, right? So
Yeah, no, absolutely. It will deter a lot of, I mean, how many people, my mom stays in Hermanus, and I mean, like half of Hermanus is just all foreigners enjoying their pension that side. Can you imagine the drawdown if you don't have, the stream of income flowing through anymore? Yeah.
Yeah.
Because obviously I wouldn't want to lose if I earn £5,000 a month. I don't really want to just only earn 68% of it. I think it's ridiculous. So,
Absolutely.
you've already paid tax on it your whole life, and saved up so that you can eventually retire. So this does put a little hurdle in the road, to put it mildly.
And Mark, coming back to the behavioral side of things, we all know tax is a trigger, more so in this country because we don't really see where it goes very well deployed, so to speak. But the natural response to something like Section 1010 back in 2020 or building up to it was, we'll just tax immigrate. But that behavior is also sitting with a lot of implications. People ended up with exit taxes that they had no idea existed. They ended up with filing problems and being penalized and missing out on missing deadlines, and then paying heavy fines. So the behavior needs to recognize this is probably coming down the tubes because, like you say, we're scratching the back of the sofa for money for the fiscus, and without looking at drastic changes like tax immigrating or relocating or huge levels of capital flight and human flight, so to speak, what are the alternatives to that? How do we plan within the framework that exists for us and keeps things tax efficient?
Absolutely. One question that we got in advance, and I wanted to cover this, is maybe a misunderstanding of double tax risk. So there's a number of clients that actually do pay income tax already on their foreign pensions. They don't have to, but they choose to, or they are quite often what we call Crown Service pensions, so civil service, armed forces, NHS, etc. And quite often what happens is the tax there is deducted at source in the UK. Now, without going into a huge amount of detail about this, because of the dual tax agreement that's in place, you've paid tax in the UK, so that goes in your favour. And what happens is the team at Galbraith Rushby would then do your return, say that you've paid some tax already, and then offset it against the South African return. Is that correct? I'm not making any mistakes there in what I'm saying?
Yeah, no, that's definitely correct. So what would happen is we would declare it obviously on this side, but we will need proof, obviously, of the tax that had been deducted on the UK side. So as long as we've got proof of that tax deducted, the only thing is that it's limited to the tax that you have to pay in South Africa. So if you paid more tax in the UK, then obviously you'll just get an exemption for the amount that equates to SA tax on your foreign pension then. Or if you obviously paid less, you might have to end up paying in a little bit. But your taxes paid on that side will most definitely be taken into account. We always, there's a definite law to allow for that. So that's nothing to be worried about. I think it's more just for the people who don't necessarily always pay tax that this becomes a problem for.
Absolutely. Okay, we'll come back to that in a minute. I just now want to zip over to the other side of the proverbial pond now, and let's talk about the UK changes that are on the horizon. So inheritance tax from 2027. So there's a lot of people that aren't aware that this one is on the horizon. So what did they say in the 2024 budget? And this is the Labour Party that we have to thank for this. Is that inherited pensions will be subject to inheritance tax for the first time from 2027. Okay, so that's what they've said. We're not in 2027 yet. There is still thoughts within the industry that this may not happen, but again, we have to look at this and plan for the worst, hope for the best. So inheritance tax, I love this saying when it comes to estate duties and inheritance taxes. Inheritance taxes are, broadly speaking, a voluntary levy paid by those who distrust their heirs more than they dislike the revenue, whether that's South Africa or the UK. So if you end up paying estate duties or UK inheritance taxes, That's because you've chosen, sometimes by not acting, to pay those levies. Where we come in the wealth defence industry is to assess those opportunities where potentially we might be able to reduce that exposure, and we'll talk about that a little bit more in a minute. So what does this actually translate into? Let me give you a case study. So let's say we've got a couple, John and Mary, in their early 50s. They live in Cape Town all the time, but they've got some UK bank accounts. They've got a investment property left in the Southwest 19 is normally the main postcode. I find that people have a property somewhere in the UK. And currently, that's what I would kind of describe as red box items. I'll come on to that in a minute, what I mean by that. But historically, the UK pensions would have sat in a lovely green box. And what does that mean? It's almost certainly tax-free or very tax-efficient. And so if they were to both pass away unexpectedly, today, they would have an IHT exposure somewhere in the region of about £80,000. Okay. Now let's fast forward and look at this change. Same asset base, it's probably gone up a little bit in value over time. And let's say they then pass away unexpectedly in 2027 after this change. Now their IHT exposure, because the private pensions are in the same red box, suddenly jumped up by another £400,000 going to the UK government in a situs tax. So we're actively warning against this and pointing out to clients that actually, compare with a year ago, where this wasn't an issue from the UK side, and then also the South African change that was on the horizon, what was perceived as the top tier solution, which was a UK pension of some description, it's starting to lose its shine in various different ways in its attractiveness. So let's then move on to what the options and solutions are. So what would we recommend if you're an expat listening to this and you're not sure what to do? Well, first things first, if you've got a UK pension, start off with understanding what you have. So what we would call a free pension MOT. We look under the bonnet and we just give you an assessment of what you have in place, because there's lots of different types. We quite often find these days that a lot of the UK providers don't really want overseas clients. We've seen the likes of Santander offboarding clients and say, we'll send you a check, good luck. We've had to deal with all those kind of challenges. But regardless, if you're under the age of 55, you might want to think about, looking at what you have in place and making sure that it's prepped, ready for this D-Day change, so that you have local management, local specialists in place running that UK scheme, which is our main bread and butter. We often consolidate multiple pots into one for ease of administration. But for those over 55, this is the real call to action. You need to really assess the suitability of that UK pension in light of these two big changes, and look at it from a specialist perspective when it comes to cross-border taxation. But most importantly, as part of a holistic, tax-efficient financial plan. One other little point to be aware of, if you're not aware already, in 2028, the normal minimum pension access age for UK pensions is going up from 55, where it's been for several years, to 57. So you might also have an issue where might not be able to get access for another couple of years, depending on when your birthday is. So if in your early 50s, you might want to just do some maths to make sure you're not caught out by that one. And that's changing on the 6th of April, 2028. So very quickly, if we go down the free pension MOT, what does it look like? Well, we ask these kind of questions of you in a review of looking at your asset base. So my first question often is, do you know who your pension is with? You might think it was with Standard Life, and then you suddenly find that book of business has been sold to Aegon, who then sold it on to Scottish Widows. And quite often people lose touch with their UK pensions. Do you know how much it's worth today? Do you have a real eye line to what it's worth and what it's invested in? I'm not talking about some generic fund called, Fund A ... Underlying, it's invested in the kind of companies that you trust and you believe in. How has Trump's tariffs impacted its value? We've seen a big drop across certain markets. And are you exposed to that? Do you know whether you're likely to be more exposed or less exposed in the future? But most importantly, how is it performing against its peers? If this was a cycle race, is your pension somewhere at the front of the peloton, or is it lagging way at the back? And more importantly then, what will it be worth in the future? If we were projecting it forward, what could it potentially be worth? And if you're not sure on any of those points, our free pension reconnection service allows you to at least get to a point where you know what you have in place before we then look at all the other bits and pieces. What we will send back to you is a very simple report. We do it on a red, amber, green basis. 4 out of 10 times we recommend to leave it where it is, but that might be changing with these latest tax changes. So I'm going to bring Jeff in now on something I touched on earlier, which is what we call affectionately the red box, green box discussion. So if we're thinking about withdrawing funds out of a UK pension, and they're probably going to end up in a bank account, and that's what we refer to as a red box item. So a personally owned bank account worldwide. Jeff, what's your thoughts on this sort of explanation for clients? What are red box items, and what does it actually mean?
Well, first thing, I think you should rename your free MOT service as your free eye opener service, because it normally stands out with quite a few unanswered questions. And Mark, I like the point that you made at the bottom there, that for anyone who's near 55 or over 55, because really this is what we're talking about now. This is really only an option for a person that has got to that retirement age or that pension age test. If you're, of course, below 55, you need to wait until that particular time to then, make or take action and make these decisions. And also, we need to appreciate that even with these changes coming into place, that a pension is there to serve a purpose. It's there to provide for your retirement. And so looking at this holistically, rather than a cookie cutter approach and saying everyone should do this, we have to make sure, you on the call have to make sure that you weigh up, what does it mean staying in the pension, and what does it mean if you exit? And if you did exit, what are the implications and what are the solutions available to you? So I think first things first, if you come out of the pension, the money needs to go somewhere. So inevitably it's going to go to a bank account. From a bank account, you can then decide what to do with it. Right? And very simplistically, you can keep things in your own name in various shapes and forms, right? You go buy another property. You could leave it in a savings account because, Lord knows Trump and tariffs are making it interesting to step into the stock markets right now. You could start up a stock portfolio in a simple custody account and buy shares and buy securities. But bearing in mind, all the while, these are in your name and you legally own them. And that, brings us to the tax system that South African residents need to be aware of. As a South African resident, you are taxed on your worldwide incomes and your worldwide gains. As well as if you passed away, granted there are deductions for this, but if you passed away, it's your global assets that are subject to estate duty. I'll add a little insult to injury and say, not only are they subject to estate duty, but they could be subject to other inheritance taxes in other countries if the planning and whatnot is not done correctly. So what do those taxes look like? Well, we are rubbing shoulders with some of the more developed markets, some of the Scandinavian, European countries. We carry the similar tax brackets to them. 45% income tax is our highest level at present. Who knows? Next couple of years it might be slightly higher. If you're involved in a business, of course you've got corporations tax of 27%. You need to get those earnings back into your hands somehow. Simplest way to do that is to declare a dividend. Normally costs you about 20%. If you have growth assets at the point that you realize them, so you either sell them or you withdraw those growth assets, or you sell a property or sell shares, you're going to be subject to capital gains tax. It's a very complicated system, but effectively your highest rate of capital gains tax is 18%. And as I mentioned earlier, if you pass away, there's a plethora of costs involving estate duty as well as executors' fees. So there's a lot of research and precedent out there to suggest that the age that you pass away is going to be equivalent to the tax that you pay, or the level of tax that you pay on your wealth. That sounds obscene, but when you add up 45 and 18 and 20 and another 20, it actually doesn't seem that far off.
Can I bring Lizette? Can I bring you in? Obviously, you get involved in this day to day, doing tax returns for clients that own investments, own bank accounts, generating interest. You know, no doubt, sadly, clients that have passed away as well. You know, we refer to these as red box taxable items. Is there anything you think we need to be thinking about, or need to add? You know, so that clients are aware of the common issues that you come across.
I just want to mention that some of your assets, if you do come from the UK, some of your assets might be excluded. So on our side for inheritance tax, so you might not have to pay on all of it. But again, yeah, that's definitely something you would need to look at from a South African, red box. Yeah, personally owned assets, yeah, the same thing worldwide. Stocks, yes, absolutely. Main residence, yes, but we do have an exemption for the first 3 million of your primary residence. Crypto is a very, very big thing currently. SARS decided to create a whole new department to just deal with crypto. So yes, definitely collectibles. Yeah, we don't include personal use assets, so obviously, but I don't think you do either. Yeah, death tax also 20% on our side. I'm assuming that's your side, that it's 20. Is it 20% on your side as well?
Yeah, so if it's owned personally, the way that we look at it is obviously it's going to, from a South African asset or something that's not covered by a dual tax agreement, there's probably going to be a 20% plus tax. You know, if there's a UK asset, that might be citus, and therefore the UK inheritance tax might apply there.
Yes.
But regardless, I think the main thing is if what you have is a red box item, there's going to be probably some tax to pay somewhere at some point in the future. And if you take, and this is the bit we're going to sort of come on to now, the sort of green box side of things. What do I mean by green box? Well, you know, Jeff, will bring you back in here on this one. So this is investing and structural options that have some form of either tax efficiency or completely tax free. So for a greater or lesser extent, a lot of different options there. What's your thoughts on the green box and you know the kind of discussion that we're having now?
Well, I like the name that you gave yourself earlier, a wealth defender. I quite enjoy that. And I think that's really what it's about, you know, protecting and preserving your wealth against the ever-present threats. Taxation, none of us can deny, is a major threat on your wealth. And if it's not dealt with effectively, it's going to take a large chunk, either from you or from your loved ones, you know, once you pass. And we really only build and protect our wealth for two reasons, right? It's to look after ourselves in the longest holiday of our lives, and if we're no longer here, it's to look after our loved ones. And thankfully, we've actually got a number of options which, in some shape or form, both locally and globally, provide a decent level of protection. I think it's really more about which is going to be more applicable and appropriate to each individual situation. You know, someone.
Yeah, and I think look, when we look at the challenge that, I mean, I often have this discussion when we're talking about, you know, the options from a financial planning point of view, saying, look, you've got red box items, maybe we should look at popping them into some form of a green box as part of a holistic plan. But what we're talking about here in this example, you know, because obviously each solution has a different tax rule associated. We're not going to go into all of that now. We'll be here all day, and I'm sure Lizette will literally, you know, be on the call for hours if we picked each one apart. But effectively, what we're talking about is, look, taking some or all cash out of a UK pension, potentially, if you've got an NT code in place before this D-Day, goes into a personal bank account, and then do we leave it there, or do we potentially look at going back into something else as a solution? What's your thoughts there?
Is that for me or Lizette?
Oh, sorry, Jeff, from your, sorry. Sorry. Yeah, but Jeff first and then Lizette.
No, it's fine. Yes.
Yeah, it's that concerning time where it comes out of the green box into the red box and moment of panic. But of course, you know, there are options from that point. I think I look at from a wealth protection perspective, I look at well, what are the threats on my wealth, and how can I effectively deal with them if I'm a client?
Yeah.
So one of the things you and I, we talk about on a daily basis, Mark, is utilizing structures. And, we're not talking about some physical structure, we're talking about financial structures. And the aim of the game is putting a legal structure in place that can now take over the ownership of your assets, right? For the longest time, in South Africa, you'd probably look at a retirement plan is your simplest form of structuring, or a trust. And then in the international market, there's of course your international trusts, which was the go-to for a very long period of time. But the reality is, you've actually got a significant number of options. But before I run through this, Lizette, I don't know if you want to add anything in regards to that move from the red box to the green box before we sort of go through these at a high level.
I think a lot of it actually, the moment you move, something happens. So it's either pay tax now or pay tax later. So yeah, I mean, moving, for example, your property into a trust, yes, that good idea, bad idea is just the fact that you actually get a greater deduction, and it depends on how you distribute the income from the trust. So there's a lot of, I mean, you really have to pay a lot of attention when you do plan. But yes, yeah, that's my side. It's just, you definitely, I mean, a trust is always a nice option, for example, but yeah, lots of deductions you can still get. I mean, if you do a retirement annuity in South Africa, but then at the end of the day, it's just much of a muchness, because you'll pay tax in any case. At a later stage, it's the same thing, both sides. So yes, not much.
Okay, so that echoes everything I think that we're talking about. That these decisions have to be taken wisely, and particularly if the NT code being in place allows a withdrawal without any tax burden. There's a deadline where if you're going to do this, we need to get on with it. But we don't know when that deadline's going to be, and it might still not happen. That's the thing. This is still not confirmed, but it's looking very likely from all the rhetoric that we're seeing from government. So, Jeff, let me come back to you then. So we talked about different solutions. So if we were starting to look at alternatives, so just run me through this diagram, and if clients are thinking about, I've taken money out of a UK pension fund as an example, what do I do with it? Do I just leave it in a bank account, or what are my options?
And looking at the flow chart, it actually looks like we're suggesting all of them in a sequential order. But anyone on the call, please realize that was an oversight in how I designed this. So coming out of that red box and potentially looking at your options, again, this could be that you use more than one of these solutions. It could be that it forms part of a much more holistic plan. It's good to just understand the features and the benefits of each, the drawbacks that might come into play as well. So what's a direct investment? Simple investment account in your name, trading account. It could be a bank account with investment capabilities. Lots of banks are launching that now. We've just had Clarity as a new trading account launched as well. It could be a LISP from one of the well-known names like Momentum, Allan Gray, Sanlam, you name it. They've all got these investment accounts. Point being is the account is typically set up in your name directly for a very simple purpose of buying securities, buying ways to access global and local markets. I guess the major drawback on that, we'll obviously come to that point. Investment property here, we're not talking about buying property companies. Here it's actually physical brick and mortar. South Africans love their brick and mortar, something physical, kick the bricks. We know it's there. It's not just going to disappear. And that's very common that South Africans own property in other countries, Mauritius, the UK, Australia, all over the show. And again, that asset is more than likely going to be in your name. If you're not buying it in your name, you're buying it in a company, in a trust. Trust me, that has significant consequences as well that you need to think about, both in the country that the property sits as well as where you are resident. We see endowment thrown around quite a bit. It's really just a tax wrapper of sorts. So you take a direct investment and you pop it into a policy provided to you by a life company. This is really a bit of a gift from SARS, because they've provided you with a bit of a leniency from tax by flattening the tax rates. So you don't pay tax at your marginal rates all the way up to 45%. You pay a flat rate of tax of 30% on any of your income or investment income there, as well as it makes probate, which it makes winding up of your estate in the event that you pass away a little bit easier, because you can nominate your beneficiaries. So that's a nice alternative to direct investments if you're a higher tax rate holder and you plan on investing for a bit of a longer term, right? If we move away from one of those three and we really look at, well, what are the ownership structures we could have? The first would probably be utilizing a foreign trust. And the one nice thing about trusts is, doesn't matter where they are, South Africa, other parts of the world, a trust is a trust is a trust. It predates all forms of tax legislation. And of course, they've been modernized and new regulations and standards have come into place, and the taxation is obviously developed over time. But what you're doing there is providing your assets to a legal arrangement that's there to look after your beneficiaries, right? And it's there to provide creditor protection, asset protection from your country risks, like economic and political risks. It's there to provide some level of tax protection as well, or leniency from taxes. But trusts, still have a place in people's planning. You just need to be very conscious of what are the implications of setting it up, funding it. What does it mean for your beneficiaries? All of those sort of things. If we look more at the retirement side of things, so moving away, I know it sounds strange. You come out of a pension to end up in a red box, only to end up back in a retirement plan. How does that all work? And this is really looking at your discretionary foreign retirement plans that are by and large exempt from taxation at source, meaning that where the pension is based, there is no tax that needs to be paid. And the reason for that is they are often operated and administered from jurisdictions like Guernsey in the Channel Islands or the Isle of Man. So they become a very tax efficient arrangement for you to continue growing your retirement pot, as well as if you're living in South Africa and your retirement pot is outside of the country, you're sitting with a primary currency asset. It's tax efficient. It's portable. It's not brought into the ambit of pension rules in South Africa. That provides you with quite a bit of flexibility and optionality when you need to start drawing on it, provide for your retirement. And then finally, if you are sitting where your situation would dictate that the money should come back to South Africa and they should not be invested abroad, then a very, very good option for you to consider, and a very tax efficient option, and a fantastic option for your loved ones and your beneficiaries, is by simply contributing to a retirement fund locally. And should you be 55, which you would be if you were considering these, immediately retiring from that and purchasing what we call a living annuity. That living annuity, to a large extent, would be quite tax efficient. It allows you to leave the assets to your loved ones, your beneficiaries as well, providing you with that safeguarding of wealth. And I think this is just a nice, simple graphic. The green light, the orange light, the red light, to sort of take you through these main topics and where.
Yeah, I think it's worth pointing out these are quite often the thoughts that are running through people's minds, right, Jeff? So, if we take these various solutions and put them side by side, let's go through those key needs. So the first one, can it stay in primary currency? So that might be pounds, or it might be a switch to dollars. I'm not sure that's such a keen conversation at the moment, but maybe euros. And each of these solutions, where they fit on that sort of red, amber, green scale. And then do you want to take us through the rest of the main points that clients are often looking for?
Yeah, I think if we start down the left-hand side, I mean, primary currency there, we're referring to a currency, a stable currency, a developed market currency. So let's, assume dollars, pounds, euros, Swiss francs would probably, be your options there. The next point down, looking at mitigation of political risk, specifically looking at what policies could come out in the future that manifest themselves normally as taxation. What impact are they likely to have? Where are they likely to have the biggest impact? So sort of just dealing with those two. It's actually a little bit unfair to give the living annuity a red face, but what we're saying there is it remains in rands. So it is not paid out or reported in a primary currency. It will always be paid to the annuitant or the person receiving the income in rands. However, make no mistake, you can tilt it towards international markets from an investment strategy perspective. The political risk side of things, I think the policy risk for anyone who, if you're still a fiscal resident of South Africa and a tax resident of South Africa, anything you own is potentially at threat if policy change is not in your favor. Think of wealth taxes, think of additional taxes, anything to that extent. So anything that's in your name and certainly within the borders of South Africa is at the greatest risk, which is why with the foreign trust and the international retirement plan, which are both abroad and outside of the country and take over the legal ownership of the assets, you can see that is fully mitigated from SA political risk. What's tax efficient? I mean, going through, not having to go through each of them, but the least tax efficient way is going to be a direct investment in your hands, where it is recognized that you own those shares, you own those unit trusts, you own that property, you own those savings. Those line items are each going to be treated as individual line items for tax purposes, giving rise to income tax, giving rise to capital gains tax. But then immediately below that, you can see you're trading off tax protection with accessibility, because the ease of access to a direct investment is much better than any of your other options, with the worst being living annuities. And again, speaking of flexibility and access, the reason we've said that it's not that accessible is because you're only entitled to draw a certain percentage of the entire living annuity value each year, and you can only review that amount once a year, which we call your anniversary date. What we're referring to with open investment universe, this really looks at, well, what is the scope of what you can actually invest in? Are you quite limited with a short list of investment securities and mutual funds? Or is there a much wider universe that you can look at? And again, a living annuity, it being a South African investment, is going to limit you to South African asset managers, albeit those asset managers might invest internationally through what we call feeders. They will all be local asset managers. In terms of what happens when you pass away, this whole period of probate, this has come up a lot recently. If anyone's caught those articles on the Masters Court and the disarray that the Masters Court is in, understaffed and apparently underpaid, and everyone frustrated and losing letters of executorship and estates going missing and things like that. So it stands to reason that I think most people would want to avoid probate. And that is that period of time that it takes from when a person passes away to when the final tick in the box is given to say this estate has been officially wound up and the heirs are paid out their due inheritance. That in itself is worth structuring your wealth, should there be absolutely no tax reasons, justification for additional tax. Justification for saving on tax. Mitigation of probate should be one of the biggest things that people look to structuring their wealth for. And second to that, succession options. Once the beneficiaries, or once your loved ones now inherit what you've built up for them, built up financial legacy, they sit with the same concerns and challenges that you sat with as well. How do I protect against unnecessary taxes? How do I create flexibility and choice? What are my options? How do I create ease of access to my money? So all of that can actually be considered when you are structuring your wealth the first time round, rather than putting your heirs and beneficiaries in the exact same position you would have been in before you considered what are your green box options. And then from an inheritance tax perspective, this looks at both South Africa as well as potentially abroad. Your direct investment and your endowment, because they remain assets of yours, are still going to be in the purview of dutiable. So your estate duties at 20% in South Africa and potential for inheritance taxes in other countries. Whereas your foreign trust, international retirement plan, living annuities, they have a structure in common, which is a legal structure owns the assets rather than you directly. I think it's fairly obvious as to which one is providing most of the green lights here, and it's also probably why in the most recent decade more and more South Africans have turned to international retirement plans as a necessary planning tool. And I do see it doesn't say international. Please, everyone on the call, this is an international or foreign retirement plan that we're referring to here. Serves as a fantastic green box as an alternative to your UK pension.
Okay, thank you for that, Jeff. We're just going to wrap up before we go to questions. We've got a lot of questions coming in, so if you haven't asked what question you're thinking about, please do in the Q&A, and we'll get to those shortly. So what can you do as we get to the end of this webinar? Well, first things first, stay informed. Okay, this is not law yet. Okay, we don't even know if this is definitely going to happen, but it looks pretty strong, it does on the stuff that's come out. So we'll be monitoring that legislative updates from the Treasury and SARS, but if they can make a U-turn on a VAT change, then other things can happen as well. So regardless, we would recommend that you sign up for our social media updates. We're out at the forefront of looking after clients in this specific area, so you'll hear from us probably first. But we're here to try and translate government speak into people speak so you can understand. But regardless, it's a great opportunity. If this has maybe got you a little bit concerned, review what you have in place. You've got two specialists on the call in Holborn and Galbraith Rushby. We're here to help in our respective areas of professionalism, but ultimately we would encourage you to create a holistic cross-border wealth plan in conjunction with a specialist. If you are going to consider, a pension commencement lump sum on a UK pension, or applying for an NT code, a no tax code, whilst that window is still open, with ourselves or with Galbraith Rushby, then we will do what we can to support you on that. And make sure you understand the timing of pension withdrawal so you don't get caught up in D-Day. We had another D-Day recently, which was the 5th of April for contributing to past UK state pensions, and we were inundated with requests on the 3rd, 4th and 5th of April. By that point, it's too late. So our call to action is don't leave this to the last minute. And lastly, just to Jeff's points here, explore your options. So we will help you consider the jurisdictions, the products, the structures, those green box options, and all of the various different variations of it that have tax efficiency and wealth planning in mind. And we will help you defend your wealth against these changes. Okay, hopefully that's it. Before we move on to the questions, I'm conscious of Lizette. There's a lot that you've added to us from an experience perspective. Is there anything you want to add first before I go into start asking anything from a Q&A perspective?
Just the one thing that I did want to mention, which is a good thing, that Jeff did bring up, an annuity, obviously pensions and whatever is not included in your estate when you actually pass away in South Africa. So that's not a bad option to consider, you know. But we've got a lot of clients that actually do go for the foreign pension fund options, exactly like you said. So that does seem to be the most favorable option at this point. But yes, do consult before you make a choice. Strongly recommend that for sure.
Yeah. And just to be clear, this isn't an advice session. We can't do that
No.
legally. We wouldn't do it
No.
morally.
No.
It's an opportunity for you just to be aware of the options that are in there in our wealth planners toolbox. You know, we use all of those solutions that we've mentioned there for different clients, from direct investments up to foreign trusts and foreign pensions and what have you. One of the things I'd encourage you to think about, though, if you're listening to this call and you're trying to select a financial planner to work with someone that can do all of those options, that has experience in all of those options. One thing that I do see, sadly, in South Africa is quite often, a product push approach, which is, let's try and get you into the same retirement annuity, the same insurance policy that we've done 10 times that week, with whatever local financial provider is the flavor of the month. That's not how we operate as a business. We never have done, we never will do. So all I would encourage you to do is ask your financial planner, are they able to advise on all of those solutions? Do they have experience in all of those solutions? How many solutions have they done in each of those categories, so that you're getting the depth of independent advice that you deserve in this very specific situation. Okay, let's move on to the Q&A now. So we're trying to answer as many of these live. We've already had quite a lot of questions come in, so just bear with us. We're going to try and wrap this up within the next 5 minutes. So we'll do our best to get through them. If not, we will come back to you with answers after the session. So let's do the easy ones first. So Katrina, yes, we will be filling out a recording of this webinar. Please do forward it on to anyone that you think might find it beneficial. Thank you very much for the question. Here we go. Question here from Jonathan. Jonathan, thank you for this. Is the removal of the exemption for foreign source pensions currently proposed by the SA a given that it's happening? Is it proposed for discussion or definitely happening? I think the summary there, and I'll go to our panelists here, is it looks very likely, but if we can U-turn on a VAT change, it might not happen. And it's better to plan for the worst and hope for the best. What's your thoughts on that, Jeff and Lizette? Jeff, do you want to go first? What's your thoughts?
Sure. Well, first off, it is proposed. It's definitely not happening. Well, in fact, when I say proposed, it's been raised as a discussion point and something to investigate. So there could be an entire U-turn on it. But we'd have to ask the question on why would they U-turn on something like that? It's clearly an area that they're focusing on, that they've put a bit of a microscope on, but it's not proposed and it's definitely not happening yet. Right. So if it is proposed, it will go through consultation. Gilbreth and Rutchby, as well as many other firms, will have their say and provide their comments, as well as other stakeholders to legislation like this. And then if it's passed into law, well, there's your D-Day. So the next budget speech, the interim budget towards the end of the year, it'll be a very good litmus test if this has remained a very high focal point or intense focal point.
Very good. Is there anything you want to add to that, or have we covered that point?
All covered.
We're good. Okay, moving on to a question here from Bev. Hi, Bev. Good to see you on the call. So this is in relation to those who have already done some of the structuring that we've talked about. So the use of a discretionary foreign pension outside of the UK, quite often in the Channel Islands. The question is, will Guernsey pensions, but also Isle of Man pensions, I would say, fall into this as well? Will those fall within those that will be taxed from South Africa? Jeff, do you just want to talk through the difference between those pensions and the predominantly UK workplace pensions?
It's a great question. Thanks, Beverly. The nature of the income from the pension is what's important, right? So the exemption that is potentially being removed is income from a pension which was funded abroad through an employment relationship, right? So you were working abroad, you paid money into a UK pension or another country's pension, You've now moved to South Africa. You're currently enjoying an exemption which keeps all of that income free from taxation. And now this change is potentially going to happen. The discretionary foreign pensions, albeit they have the same word, pension, because it's there to provide for your retirement, is you've already paid the tax and you're taking post-tax money and you've contributed to this form of discretionary foreign pension. So the nature of the money coming back out to you when you retire is very different to that of the income from a foreign pension through employment. And we can go into quite a bit of detail, but the way in which you'd look at the taxation applicable to income that comes back to you from a discretionary foreign pension is similar to how a beneficiary would be treated with a distribution from a trust, right? Where if there are capital, well, if there's capital growth in that foreign pension and that is what is withdrawn and paid out to you, you pay capital gains tax. If there's an accumulation of income and that's paid out to you, you pay income tax. However, you are also in a position to take out your original capital, and that original capital has already been taxed and is no longer subject to tax. So I hope that answers the question, but it will not be included in the exemption or any changes to the exemption.
Fantastic. Thank you, Jeff. Another quick question here from Jonathan. So if we have an NT tax code pre-law change, we are exempt. So just to be very clear on this, if you're over the age of 55 and you have a predominantly UK-based pension, is the one that a lot of people have that was on this call, and yes, you have probably taken your pension commencement lump sum, so the 25% tax-free bit to start with, you're then on the payroll system in the UK. That's when the team at Gelbith Rushby can dive in, apply for your NT code between SARS and HMRC. Once that NT code is in place, yes, in theory now, before D-Day, you could do a full withdrawal of a defined contribution scheme, and then that would end up in your bank account as a lump sum for you to do as you wish. And currently, until that change, that would not attract income tax. But again, I come back to everything we've been saying through this. Don't attempt to do that without proper advice. Speak to a specialist and look at the options, because it might not be as clear as that in your case. But hopefully that answers your question. Okay, moving on to last couple of questions. I'm conscious of trying to wrap up and making sure that we don't go over the time. So last couple of questions. So the question here from Callum, what would be the proposal solution end goal be for a defined benefit pension holder? If I were to transfer, it appears a UK SIP would no longer be ideal. Wow, that's a tricky one, and I'll do my best to try and answer that. So there's two categories of clients in this bag. So there will be those with a defined benefit pension that is paying them. And then there are those that have a defined benefit pension that is not yet paying them. And I'm assuming this is a UK scheme. Let's not even go there with the other nationalities as well. So a defined benefit is normally a promise to pay. So it's a fixed amount that normally rises with inflation. So sadly, if it's already in drawdown, if it's effectively already in place, it's unlikely that anything can be done apart from, as those payments come out, put them somewhere, as we've been talking about. But you don't have the flexibility with a defined benefit scheme. It's very static. It's very safe. And anybody that's listened to my webinars before, I often refer to those type of schemes as gold-plated tanks. They roll along very nice, very slowly, and they're very well armored and safe. But in this kind of situation where you might want to be able to pivot, they're not as effective as a car, and a car would be a defined contribution scheme, a money purchase scheme. So that's unfortunately the challenge that we don't really see a solution to at this level, at this stage at the moment. Those that have a defined contribution scheme that they aren't receiving yet, so they haven't yet received benefit from it, potentially that might be something you might want to consider looking at from a transfer perspective. But that, I have to underline, double, triple, can only be done in conjunction with a UK-based financial advisor that provides very specialist advice on those options, because we want to make sure that you aren't put in a negative position overall. So in both cases, I would take formal advice before trying to do anything at all, because that is quite a thorny question. Jeff, is there anything you can add to that one? I thought I'd throw that in as one of the last ones because it's probably one of the most challenging questions technically out of the bunch. Anything to add?
No, I think you've covered that off. It's a tricky situation to be in if you've decided, I know what income I'm going to receive from this, and I'm going to go with that for the rest of my life, expecting legislation not to move and you planning accordingly. And then you get thrown with something like this and you're almost stuck in that box, which makes it very difficult. But
yeah. Okay, last question then. It's a fairly long one, so we'll try and keep it succinct before we wrap up. I'm sorry that we haven't been able to get to everyone's questions. We will reach out to you afterwards to try and help you if you've asked questions. So I'm still far off retirement, so 20 odd years. But do you have any advice for someone in South Africa but working remotely for a UK company? I'm currently paying into a UK pension chosen by my UK employer, but I can't use my payments as deductible against income tax when income is declared in South Africa, as it's not a local pension, and therefore when I receive it again in the future in South Africa or even in the UK if I move back, it will be taxed again. I'd previously been okay with not being able to use it as an expense against my income, as I knew I would be taxed on it again, but when I withdrew it back, but now that situation is changing. There's a load of components to that, Jeff. I can see you. So the reason why I think we're both raising our eyebrows is we've done a webinar actually with Janine and others from the tax community on the importance of understanding where you sit from a cross-border taxation perspective. So remote workers like yourself, yes, you can be on UK payroll technically because 10 years ago, remote working in other countries was very, very challenging. Now, here we are on Zoom. I'll be on a Teams call after this, etc. The world has changed, but the regulations has not caught up. So legally speaking, the maximum that you can put into a UK pension if you're working outside of the UK is £3,600 a year. But what quite often happens is that people work in the UK, they say, I'm going to go back to South Africa, I'm going to work down there, and we carry on payroll. It has huge implications for the employer potentially as well. And I'll bring Lizette in on this question. Potentially, if they have a UK or foreign national working for a foreign company in South Africa. So if you've managed to maintain this situation, one of the challenges is sadly that it normally happens when an overzealous HR person spots that you're working remotely, and then the whole thing stops because it becomes very challenging for payroll and other bits and pieces. We've discussed before about contracting options on other webinars, about the use of foreign agencies as well. That's too much for me to go into today. So that it's a big question. It's probably best to have a discussion with specialists just to understand your specific situation. Is there anything to add to that on our final question?
If you're working for a UK company, paying towards a UK pension, but sitting in South Africa, it's already not exempt. So I think you've already crossed the border there. So that might be something you need to just get some advice on. So yeah, you'll definitely get a deduction though for your pension payments. The part that you might not have paid tax on during your lifetime of contributions, there is a little bit of a deduction there. So yeah, I definitely think you need to just chat to somebody on this side to just make 100% sure what your tax situation currently will be and how to best manage that. But yeah, sadly, if you're in South Africa contributing, then definitely that's already not seen really as, because I mean, when you declare it on your return itself, you have to actually declare how many work days were you out of the country in any case. So yeah, definitely something you need to seek advice on.
Excellent. All right, Lizette, thank you very much for your input. Jeff, also, thank you very much for your input. Ladies and gentlemen, if you have follow-up questions, please reach out to your Holborn advisor that's invited you on the call, or the member of the Gelbreth Rushby team that's invited you on this webinar. And feel free to reach out to myself if you're not sure, and we'll do our very best to support you through this challenging time. Thank you, ladies and gentlemen, for taking the time, and all the best. Speak to you soon. Take care.
Thank you.